Good morning, everybody, and welcome to our 2021 housing market forecast. Today is November 3rd. November 4th, the day after elections. We don't know who the president is yet, and I know you guys are all excited and hopeful on the outcome that will happen. So thanks for taking a break and listening to our housing market forecast. I'm Anthony Volin, the owner and broker of the Collective Realty, and I'm your 2021 president-elect for the Greater LA Association of Realtors. I'm very passionate about helping realtors build wealth, and that's why I'm putting this session on for you today. I'm going to give you lots of different tips, so get out a pen and paper and write a lot of this down. We're going to be reviewing lots of different slides and tons of graphs and stats, which I love because that's the truth. And the truth and the facts are what I base my business on, and I figure out how to build a business based off of that. So California Association of Realtors has done an incredible job with really surveying home buyers and sellers and pulling data from the economy, from the state and from local that we'll be using today. So I'll help you interpret that data and help you figure out how that's going to help you have a really great business moving forward. So let's move right in. I'm going to start sharing my screen. And let's start from the top. All right, so let us first take a look at kind of where we were last year and what we expected this year to look like. So if you look at the middle column, this is the forecast as far as what we're predicting the end of this year to actually what we thought it would look like. And the final column is the 2020 projected and where we really think we're going to end up this year. So we all know it's been a real challenging year with COVID and so many things happening. You know, in 2019, when we made these 2020 predictions, the biggest thing we were really looking at was the trade war with China, and that was going to affect the market. We were coming off of a really strong market where there was an increase of sales and so on. Prices had slowly been going up. We thought maybe we were at a height for prices. We thought maybe, interest rates are at an incredible level and they might hit an all-time low. And then COVID happened, and let's see how that really affected everything. So our forecast from last year, how we actually are going to see a change. We thought there would be a slow growth in the amount of sales that happened by the end of the year. However, we're going to see a decrease of about 4.5%. So sales are down about 4.5% by the end of the year, which is not too bad. Last year they were down about 1.2%, considering we've just gone through a huge huge experience that none of us have gone through before with COVID. Now here's a really interesting one. Prices, right? We expected last year that prices would rise slightly, to go even higher than we thought they could possibly go, to a median price of 607. Now look where we are now. Prices by the end of the year were expected to rise over 8%. That means homes are 8% more expensive this year than they were last year. The median price for California will be $640,000. If you were to ask me that in March or April when COVID first started, I would have said that this is absolutely not possible. I mean, this really has been a year of just me saying, what? All of us, being baffled by so many different things. And this is definitely one of them, where prices actually have increased by the end of the year. Looking at it last, April when we were really getting into COVID, I don't think any of us would have guessed this. Now, when we look at interest rates, last year we predicted that 2020 would end with rates on an average of about 3.7, which we thought was amazing. We didn't think they could go lower than 3.9 from last year, and they did. And now look where they are. They're even lower. They're going to be at about 3.2% by the end of the year as an average for the year. That is amazing, and we're going to talk a lot about rates and how that's affecting our market moving forward. Housing Affordability Index, now these numbers are going to stay about the same. And US GDP, we expected a small growth last year by the end of this year, but of course this year we're going to be actually experiencing a decrease because of what's happening with COVID. Now let's talk a little bit more about the economy and where we've come from. I don't think we need to remind anyone, or maybe today we do, but hey, we're still in the middle of COVID. We've come through COVID. I know we have elections on our mind, but COVID is really going to be the most important topic of this session and where we're going. So COVID was a huge factor of what's gone on this year. The US economy contracted at the sharpest rate on record in Q2 of this year, almost 33%. Q1, we saw it go down about 5%. Q2, down 32%. This was huge. The speed over the last 6 months of how all of this amazing stuff has happened has really, really been incredible. I think it's worth looking at. When we had the Great Depression around 2008, 37 million people lost their jobs, and that happened over 2 years. Now we've had almost double that amount happen. 61.9%, 61.9 million people have lost their jobs in just 29 weeks. This huge spike, we see that. We see the numbers coming down, but there's been a huge number in such a short amount of time. That was something that really shocked all of us, and was actually quite fearful to see how it's going to affect the real estate market moving forward. So here's, kind of looking at different, forecasters of how they see Q3, Q4 ending out and what they anticipate for GDP for next year. There's a lot of discrepancies for the second half of this year. However, when we look at 2021, this is bringing us all hope that there will be a growth next year. And they kind of range between 3 and 4%. So this is something that is hopeful. We expect to end this year, somewhere between 3 and maybe up to 6%. Of a loss of GDP. Next year we will have a growth. So that is definitely hopeful for us. The government really had to step in, and they did react quite quickly this year, much quicker than they did in the Great Depression, which has really helped, keep us from getting to a really devastating place in our economy. You'll remember that we got $1,200 checks, which, hey, in LA, it's not much, but overall in the economy, we think that it did do something. There was an unemployment bonus that happened. They were very quick to respond, which we're definitely grateful for. And here's a few of the programs, that we can all recall. C.A.R.'s Act was the biggest one, $2.2 trillion pumped back to us. The Paycheck Protection Program. I know so many people who were able to maintain their employers because of this program and help keep people being paid so that they can pay rent and make their bills and move forward. Because the amount of job losses that we did have, there was also some stimulus and some help that was helping us to get forward, right? The monetary policy really also was on our side this year and helped us. It kept rates to almost zero. The Feds kept it there, and they promised they're going to stay there, I think, probably till 2023. So that's definitely good news for us. And direct lending to banks, major corporate employers were happening, temporary relaxation of regulatory requirements. There was a lot of things that were happening to help us keep our lending markets open. Things slowed down and some things shut, and we lost programs for the first couple months of the pandemic. But pretty soon after that, things started to change and started to come back. I think the main thing that this graph really shows is that it's showing that the Feds are willing to tolerate inflation. They weren't quite willing to do that so far in the past. They really fought that, but right now they're willing to tolerate inflation in order to get jobs back, which is important to help us for this road to recovery. So we love seeing that. Unemployment rate really peaked right at the beginning of the pandemic in April and May. And then as we look, it's come down to about 8.4% in the US, but more importantly in California, 11%. And where we are now, if we were to look at the next month in September, the rate was about 11. So it's still coming down, but it's starting to come down at a slower rate. And that's where we're at. When we look back at the Great Recession, where we were with unemployment, the highest that we got to was about 12.3%. So we surpassed that for several months, but we're already below that, and it looks like we're on a path to stay under that. So it's a very different time. This is a much quicker type of reaction and environment that we're dealing with, but it's something that's still going to have lasting effects through this year and next year and into the future. So we'll be trying to determine how that will affect our housing market and our jobs as realtors. Jobless claims. We had the most amount of claims towards the beginning, and the amount of claims have kind of peaked and flattened out. However, we still have quite a few jobless claims coming in every week. When you look before the pandemic at the left-hand side of the slide, we are at, we were about 200,000, 250,000 kind of on average before. So we definitely have a way to go. We definitely have a way to go. Job loss, another way to look at it, in March and April, we had the decrease, and then moving forward, we had an increase. We're starting to recoup some of these jobs. Quite a bit came through in June, and then a slow growth since then. Consumer confidence, this is good news. We really saw a good surge in September where prices came up. I did some research and looked at October as well. October, the number seems to be staying about the same around here. We still have a ways to go, but it seems like we've got through the worst of it and we're starting to move forward, which is good. This slide is huge to me. Consumer spending hits all-time highs in August. Wow. This is just, when you look at all these different ways people are spending money that are hitting an all-time high, this is really, really great news for our economy, because that's keeping people employed. It's helping to bring back jobs. It's keeping money moving through our economy. And that's what we need to keep our industry moving, right, is a solid economy. So consumer spending hitting all-time high is just really phenomenal. And we anticipate those numbers to probably break records again moving forward. Let's see what happens this holiday season, if they become even better. Hopefully they do. And again, just to keep that money moving. Why consumer spending is so important is because it really affects every part of our market and so many different jobs. Just a quick breakdown of that. We had, even during this pandemic, it wasn't like everybody's job, everybody was having struggles and financial problems. There were a lot of winners and a lot of people were doing well. A lot of companies were doing well. Obviously, Amazon was the biggest winner. But even a company, on the right, Peloton, a local company that really has done well in this environment, and that's kept money flowing as well. Our industry, we've seen, which we'll talk about, has also been one of the people who has not had a huge loss or hit. For many realtors that I've talked to, their business has increased this year and they've been doing just fine. So we'll see if that's normal or not in just a bit. Now, retail apocalypse, right? There's a lot of stores that have not been doing well, but these stores have been on the decline for several years, right? We kind of see now during the pandemic that a lot of trends are just being accelerated because of the pandemic, that there's not a whole lot of new stuff happening, but a lot of the trends are just being accelerated. And we've seen these people hurting for years, and they're hurting now. They're just hurting at even a faster rate. Commercial office space is something that's changed quite a bit this year. I've talked to a lot of real estate brokers and a lot of office managers, and when their leases are up, they're not renewing their lease. They may get a new space, but it'll be much smaller. And that's definitely something that we're seeing in a lot of industries. A couple big attorney firms that I network quite closely with have given up several floors of office space downtown. They're not giving them up just for this year in the pandemic, like they're giving them up. More and more people are working from home. Twitter said next year, anyone who worked in their offices, next year they're allowed to work all year long through their home offices, that people are actually being productive working at home. I don't think that everyone's going to continue to work at home, but I think that things will be different, right? And we'll just kind of have to wait and see what that is. And some of these commercial spaces that may have quite a few vacancies, maybe we can repurpose them for something else. There's a few bills that I've been chasing in California that are really looking to repurpose some of these buildings into residential buildings and to turn some of these into that. If you look at the top right-hand corner, that's the C.A.R. building that's, in K-Town on Virgil, near downtown LA. That building is an office space right now. That building, the plan is that C.A.R. is going to be tearing this building down and turning it into office space, but building higher and putting in quite a few residential units, and they're going to be workforce housing. So there'll be special homes that are offered to vets, to teachers, firefighters, workforce housing that will be put into there. I think, don't quote me, but I feel like there's going to be over 100 units that are going to be built. So that would be a great sign if we saw some of these buildings being repurposed to housing, because that is something that we need intensely in Los Angeles, and especially in this whole state. Multifamily has been extremely affected this year and is going to continue to be. Landlords just haven't been treated the same as tenants have this year. You know, the tenants have had a lot of things go in their favor, but landlords haven't. A lot of them have been hurting. And when you understand that over half of the landlords of multifamily properties are small mom and pop owners who just own a couple buildings, and this is their main source of income, their retirement, what they're living off of, and they're really being hurt. So multifamily has taken a pretty big hit this year. You know, how many tenants are going to be able to repay later on this year as they're supposed to be repaying because of the eviction moratoriums? You know, we'll have to kind of see how that happens as well. Prop 21 and 15, hey, this is good news. It's not finalized yet, but I think about 80% of the vote is in, and it's looking like Prop 21 is definitely going to be a no. That would have been a real disaster, where it put crazy, very restrictive rent control on even some single family homes and condos, and it wouldn't allow owners to set the price of their listing. So when a tenant moved out, there would be a certain percentage that an owner would be able to raise their rent. So if an owner owned an apartment, say in West Hollywood, that was on rent control and they're renting it for $1,000, but market rent is $2,500, they may only be able to raise it 10% and charge $1,100 when the market rate is $2,500. And that person who would apply for the rent could be anyone. So it wouldn't be someone who's making low income. It wouldn't really hurt anyone. It would just be, it was a mess. And luckily we're seeing that Prop 21 is going to fail. Prop 15 is also something that would affect multifamily in a lot of commercial spaces. And that's also looking like that's going to be a no, where property taxes could be reassessed. So that could hurt a lot of small mom and pop businesses, as well as multifamily owners. And of course, those costs just trickle down to renters, causing rents to be higher, and for businesses to pay more in rents. And this is not the time to do that. So that one's not called yet, but it's close. Let's keep an eye on that. You know, this is kind of a cool graph. Trump has said we're in a V-shaped recovery, we're going to be, but it's just not, we're not seeing that. We're seeing more of a K-shaped recovery, where there are some fields that are recovering quite quickly. Professionals, you know, technical jobs, white collar workers are seeming to have not been affected as much or recovering quicker. But, you know, everyone else, a lot of the people who are, you know, in restaurants and lower income jobs are not quite recovering yet. There's a lot of jobs that have not been replaced or have come back yet, or incomes just are not quite the same. Now, this is another way to look at it, where you can see the top half are the majority of the people who have lost jobs, and it compares them to their average weekly wages. You can see that the majority of people who have lost jobs have been lower income wage earners. The bottom half has not lost as many jobs, and their income levels are much higher. Now, what does that mean for real estate? It means a lot, right? Because a lot of the people who are purchasing homes are the bottom half of this chart. Those are people who have lost less jobs, whose income has been less affected and are higher income earners. So for home sales, that's great news, where, you know, we see that COVID hasn't affected the home buying process as much as we might have thought it would have. Now, however, on the rental side, oh my gosh, it's been completely different. We've seen a decrease probably in rents that an owner is able to get by maybe 20% in LA. I think San Francisco had 30% decreases in rents. So the lower income earners are most likely the renters, and The renters are jobs haven't quite come back yet, or they're not making as much, or they're working less hours. They're just not able to afford the high rents that they were before, and there's not as much demand for that. You know, I've seen so many people who have moved in with their family and they're just not renting at all. We would get a lot of young people moving to LA, trying to start a job or a career, get into the entertainment industry and be renting places. They're just not coming right now. They're staying home with their family or in their cities in other states. So the rental market has been affected, but the home buying market has not been as affected because of this. Now, unfortunately, we see disparate impact in many, many areas in our country, and we see it now again with unemployment rates based off of ethnicity. You can see in the upper right-hand corner, Hispanics and Latinos, 17.6% of Hispanics and Latinos, the unemployment rate is 17.6. For Black or African Americans, it's 16.8. When you compare that to whites at 12.4, that's a big difference. And you know, we see that happening in so many different areas of our country about, you know, this disparate impact, which just needs to change. So it's happening in unemployment, and it's definitely something we're taking note of. Financial hardships, you know, when people were surveyed, one question they asked was, you know, have you used up most of your savings since the pandemic? And the left-hand corner says Latinos, 46% of them have, 41% of Native Americans have, 41% of Blacks have, and it's much less for white or Asian. When you say to people, have you experienced financial problems since the beginning of coronavirus? 72% of Latinos have, 60% of Blacks have, 55% of Native Americans have, and you see Asians and whites at the bottom are much less. So just another way to kind of look at that data. Presidential elections, you know, we got to talk about it, right? Latest we heard right now is Wisconsin has counted all their votes. Biden has, you know, won Wisconsin with 20,000 lead. However, it's within 1% margin, so they're going to be recounting that and seeing what happens. We don't think that'll make much of a difference, but we're still waiting to hear from Arizona, which Biden has a lead in, Nevada, which is close, Michigan, which is close, Pennsylvania, which Trump has a lead in, and Georgia, which Trump has a lead in. Overall, it's looking hopeful for Biden, but you know, we'll have to wait to see what is going to happen through the next day or two, and you know, how is that going to affect our business, our real estate market? It will. And you know, one thing to kind of take into consideration is, you know, depending on what type of a county you live in Los Angeles, it's very heavy Democrat, that if Biden wins, just because he won, the mindset of the consumer, the hopefulness of stability will be stronger than if Trump wins in the way that people feel in Los Angeles. That absolutely has an effect on how people buy and sell homes. So, you know, if you're living in a Democratic county and Biden wins, it's gonna help your market. And if the opposite person wins, then it's not going to. You know, kind of looking at Biden's website and his package for homeowners, he does have a plan of $640 billion to put in to end redlining, to even down payment assistance programs, to bring back the fair housing rule that Trump gave away. These could be good things for the country overall, no matter what county you live in or what state you live in, what color it is. That could be helpful. So, you know, let's keep our eye on that. But overall, during a presidential election, things slow down. So don't be too worried about that. A month before, a month after the election, when the stability and the understanding is not quite there, the confidence isn't quite there, it will affect the real estate market. Things will slow down a little bit. We always see that. We do notice that it's happening now, and we expect that things to kind of come back to a normal market, you know, moving forward, but it might take a little bit of time. One good thing also regarding the election for California is Prop 19. Prop 19 is looking like it's going to pass. This is a proposition that California Association of Realtors put on the ballot. They spent a lot of money. A lot of you realtors out there listening spent a lot of time, you know, trying to promote this proposition, as I did, and we did a lot of webinars on it and try to get the education out there. And it's something that will help seniors be able to move to any county in the state and bring their property tax base, their old original property tax base with them when they move. So that just makes it more affordable for seniors, fire victims, and severely disabled people to be able to move. That frees up inventory for us. C.A.R. estimated it could free up 100,000 transactions because of that. You know, that's huge. There's 200,000 realtors in the state, and if we got 100,000 more transactions, that's, you know, on average half a deal per person. You know, if you're a working realtor, we know that you're getting a majority of the deals, and a lot of realtors, you know, who are not working as much or just holding their license somewhere, aren't doing anything. So that could mean 2 to 3 more deals for you just because of Proposition 19. So that's something very hopeful to kind of pay attention to see if that ends up passing. And if it does, it's going to be a plus for us as realtors, and it's going to be plus for our seniors who are homeowners, giving them the opportunity to move to anywhere in the state and keeping their property tax base. So educate yourself on that proposition if you haven't already, and make sure your sellers are aware of that. Let's look closer at California. This is one of my favorite kind of stats that C.A.R. does, and this is their home buyer, home seller survey. I can put together a whole other class on this, and I probably will do another webinar on it, but I pulled out just a few of the slides from that that are showing good news for us. And this is saying, you know, if you're a home buyer, do you think it's a good time to buy a home in California? This left-hand side. Now, if you see, this is up to 34%. 34% of people think that it's a good time to buy now. That might not seem like a big number, but when you look at it where we are now, you know, in the middle of COVID, having the highest number that we've had in several years, this is a good sign. This means that your buyers are out there, that they're hopeful. People are hopeful to buy, that they think it's, more people think it's a better time to buy now than they have in the past couple of years. So we as a realtor need to use that in our business plan and make sure that if you have the mindset that, oh, this is a terrible market, nobody's buying now, everyone lost their jobs, and everyone thinks it's bad. Well, that's not quite true. The confidence level of our buyers is higher than it's been in several years. So, you know, change that mindset if you were one of those people. The same thing, even at a higher level, is happening for sellers. You know, we're almost at the highest point we've been for confidence in a seller if they think it's a good time to sell. We're at 58%. This year in February 2020, we were the highest. That was 62% right here. But now we're at 58%. So, you know, people are confident in working with a realtor and moving properties. It's on their minds, and their confidence in doing that is good right now. So it's a great time really to reach out to our home buyers and sellers and, you know, stay in relationships with them. Now, okay, let's be honest here. The reason why we're in a V curve for the real estate market, which we are, we've come down quite a bit and we've rebounded pretty quickly. And you'll see that more and more through these slides, but it's because of interest rates, right? Interest rates have never been lower. We're down to, you know, under 3% right now. Last year, we never thought we would be getting under 3%, and here we are. This has been a huge help and bonus to people for refinancing, which is amazing. Opportunity for our, you know, sellers that we sold to even a year ago to reach out to them and have them refinance and help them to build that wealth. So refinancing is huge, but also it's allowed buyers who weren't able to afford a home last year afford a home. We haven't seen prices change that much in many areas, but with interest rates changing substantially, the buying power of a buyer is much higher than it was a year ago. So, you know, keep that in mind too. If you had a buyer who was frustrated last year, who could afford a $600,000 condo, this year they may be able to afford a $700,000 condo and get that extra balcony space or rooftop or whatever they're looking for now that they couldn't afford last year. So this is definitely great news for us, and this is what's keeping our market moving. If you're a lender, I'm sure you're really feeling this as well. The first graph is comparing week to week, and the next graph is year over year. So let's just look at the year over year change in mortgage applications for purchases. This is not for refis, just for purchases. That means that, you know, just a couple of weeks ago when this data came out, that there was a 25% increase in in mortgage applications for purchases than there were last year. Again, that's showing that the confidence of buyers to buy right now is very, very high. Tap into that. Don't neglect that opportunity. If you've been working with a mortgage lender this year and they're a little slower or take longer to get back to you, yeah, they've been overworked. Their business has gone crazy. Their refis have kept them extremely busy. I mean, we were even seeing that some of the big companies like Wells and Bank of America were increasing their refi percentage rates. So instead of refining you at 3%, they were refining you at 3.5% because they just didn't want that business. They couldn't take it anymore. They were so busy. So, a lot of the mortgage brokers and mortgage bankers that a lot of the realtors tend to refer and work with, they were doing a lot of these referrals and were really overworked. It's slowed down, but they're still very busy. And as you can see, their business is up 25% compared to what it was last year. So people are trying to find out if they can be qualified and figuring out how to take advantage of these rates and get into the market. Again, that job losses haven't hit potential home buyers as hard as for the people who are buying homes as hard as we had maybe thought or kind of envisioned. It's a lot of the lower wage earners that were affected. And I mean, you can see the biggest loss obviously is up here, hotel, bar, restaurants. Those people are still, not really working yet and have not recovered. But luckily for real estate, we seem to be okay. Now, this data really is going to be comparing the first real month that we hit COVID. It was something that I was tracking really closely to see how is COVID going to affect real estate this year? What are we going to look like? This is kind of the numbers that I was using to judge what was going to happen throughout the rest of the year. So what we saw was definitely a slowdown in home sales. Year over year change, 12% down. When you look at prices, we saw prices starting to go down. So they were going down, almost 4%. Inventory was up, so things were sitting on the market longer. And overall prices were selling, close to asking price. Now, when we just moved just a couple months into the market to our summer, all of us felt this complete shift in the market. There was some pent-up demand. There was more confidence that was happening, and the market totally shifted. We saw prices raise in August of 14%. Inventory was cut in half. Places were on the market for half the time. Average was 2.1 months. 13 days median on the market. This was really, hopeful for us that we were seeing this surge, because a lot of us were just wondering what is going to happen to us over this next year. Our market was just at a standstill for a while. And then luckily we were, declared essential business. And as long as we were following COVID protocol and we're being extra safe and cautious, we were doing that. Not allowed to host open houses. We're still not allowed to host open houses. We have to have appointments only. But you know what? It looks like we may not need those open houses to keep our market going, because things are absolutely doing just fine at this point. Sales momentum continues the highest in over 10 years. So this is definitely a good sign that if we see sales moving, this is a great sign for the market. You see our dip at the beginning of COVID, but things have picked up and have gotten much higher than they have been, the highest level in over 10 years. Increasing sales have happened all over California, not just in LA, but all over. This chart was a little bit interesting to me when I really started to analyze it. It's showing, the numbers that I'm looking at are down here. It's showing that any property that was over $1 million, that there was an increase in sales and price in 2020 over 2019. So in the upper end. And when we really look at that and analyze that, it was really happening in the $1.1 to $2 million range. If homes were priced over that, things were still, slowing down a little bit, prices coming down a little bit. But between 1 and 2 million, it was still a hot market. It was increasing, prices were going up, more sales were happening. Now, I would have thought over this year that the lowest part of the market would be the hottest, right? And the prices would go up the most, but it really hasn't. This is where we see that there was, bigger movement in the market in price and volume in 2019 than there was in 2020. I would think, oh, people are making less money, so they're going to spend less money. But again, if you remember the chart we went over, that the lower income jobs were affected most, the upper income jobs were affected least. That's definitely going to have effect on the lower end of our market. There are less buyers for the lower end of our market right now than there were last year because of what's happened with our economy. Our middle market is still, again, outperforming. Even 500 to a million is doing better in 2020 than 2019. But this lower end really had some struggles. I mean, I always think that this lower end in LA, a lot of times they're investors who buy, condos or studio units to rent them out. And I've had a studio unit on the market that really sat this year that would normally never sit, and there was just a lot less investors looking at that. So that kind of opened my eyes. Like, okay, investors and lower income earners are not really moving right now. Is that just me, or is that something that's a trend that's really happening? We're going to talk about investors later, but I will be showing you that investors buying properties is absolutely down this year. So let's talk about why, and we'll get into that in a bit. So what lies ahead? This shows our pending sales month over month. So, we saw the biggest increase here in May, June, July, August. Things started to sell. We actually have a decrease. So we had a summer surge and a summer boom, and guess what? That's kind of done. Don't think that if you were working the summer that it's still the crazy market that it was then. You might have a deal or two that's happening that you feel is crazy in multiples, but overall the market is not increasing or getting crazier. It's kind of just slowing down, decreasing a little bit. We typically see this anyway when there's an election or at the end of the year. In the winter, things will slow down a little. So that's what we are seeing. That's what to expect. Don't expect, the crazy real estate market that we felt this summer to go through the winter. Median prices, again, who would have thought prices would be at an all-time high the end of 2020? This one just really, really, really shocked me this year. I would have never said that in April or May. But prices overall, we think they're going to be up again by about 8% by the end of the year. Just pretty incredible. Let's see. So inventory is down as sales improved, right? So as more people are buying, there's less properties for sale, and there's fewer new listings that are being added to the market. We're not seeing that influx of inventory yet. People aren't moving at a crazy rate because they're, COVID's making them move, or they want to get out of the state or the city, or they can't afford their homes, or there's foreclosures. None of those things are happening. Not that they couldn't happen in the future, but as of right now, we're not seeing an influx of listings. Our inventory is very low, and that's really keeping things down. When you look here towards the middle of the screen, August 2019, we had a 3-month supply of inventory. August of this year, 2 months. So, things are selling quicker, and there's less things that are on the market. This one is a big deal, active listings. If you look all the way to the right, when you see a graph that changes this dramatically, something big is going on. And this is definitely something big. 50% sorry, it was a late night with the election. It's a little more coffee. 50% less inventory on the market, this summer than there was last year. That's huge. We have that big pent-up demand that really bought up everything. Let's see what happens moving forward through the winter. But so far, our inventory is very low. That's something that our buyers need to be aware of, and I'm sure they are. But letting them know that, hey, we don't expect a ton of inventory to come on the market. It is what it is right now as far as that, and it is much lower than it was last year. So let's look at some of the big cities as far as a little bit more detail on kind of what's happened with them as far as price, and then we're going to see LA. And LA is pretty different than some of the other cities and the state, right? Of course it is. So San Diego, prices have gone up about 10% this year. The median price is up, and all the way to the right, the active listings is down over last year by about 46%. 10%, their 10% sales is actually up, so good for them. California and Los Angeles, wow, here we are. Look at our median price. Our price median is up 20%. to 995,000. We have never been over $1 million, but it looks like we're heading to that point for a median price in LA. I mean, gosh, I remember us just hovering around 700,000 for so long, and now we're just bumped up to 995 as a median price. 20% increase this year. Home sales are a little bit slower, a little bit down from what they were overall last year. Active listings are a little bit lower than they were last year. But here's one thing that I really, thought about. It says properties are selling at 100% of list price, but then when you look at this number all the way over here, 23.8, what is that? That's the percentage of active listings in Los Angeles that have reduced their price. So if people are reducing their prices, how are they still selling at 100% of list price, of sales price to list price? So this is the actual sales price of what it's listed at that moment, not the original list price, right? So that's another number to look at that I look at through the MLS, and you can get that. But you do want to see what is the difference of how are properties selling compared to the original list price. So to me, if we see this 23% number of prices being reduced and then properties are selling pretty much at what they're listed at that moment, what does that mean? And prices are going up, like, how do you make sense of that? Well, it's pretty clear to me that realtors are just overpricing their properties. So if you're having 23% of the listings are having to be reduced and our prices are actually increasing, that we're not chasing the market. We have unrealistic expectations of where we should be pricing our homes. We have to educate our sellers. We have to educate ourselves on the neighborhoods we're working on to really know what are things selling at and show those stats to the seller. Because if you're overpricing these houses, you're doing a disservice. And by the way, don't be hypnotized or bamboozled into what happened this summer, because maybe you could overprice your home this summer and it would sell over, but that market is done. It's not happening anymore. So as we move more forward into this market, be aware that you have to price your homes well, and overpricing them is not going to do a service. And as properties sit on the market longer, you don't want to lose that listing because you just took the listing because you promised them the highest price. I've seen too many listings pop up, all over areas that I work in that I know are overpriced and they just don't sell. So please be aware of that. Educate yourself on that. Don't price your properties alone. Talk to other realtors, talk to your manager, talk to a coach, do something to make sure that you're really educating your sellers on how to price the property, because this number just does not make sense compared to the market that we're in right now. It's not acceptable to me as a real estate professional. It means that realtors are not doing their job. So we can look at a few other cities. Let's see. Thousand Oaks, for example, their prices have actually come down slightly, but the amount of homes that are selling is higher. The amount of listings that are on the market has really come down. So every neighborhood, every suburb is going to be a little bit different. Average days on the market, 45, much more than you saw in LA, which was 14 days. The resorts are something absolutely to pay attention to. In LA, we have a lot of people who are buying vacation homes or vacation rentals in different areas. And La Quinta, the desert, I've heard it's just really, really, the market's just really on fire right now. It's doing really well. And you can see that here. Percentage of change from last year in price, median price, 43%. This is the highest I've seen in any area. 43% increase. That the amount of homes that are selling is up almost 100%. There's a lot of activity that's going on. People are buying there. So, that's really something we didn't expect. This year we thought that the rental market was going to be, and vacation rental market was really going to be hit, especially because of COVID. We thought that these rentals, people who had Airbnb rental businesses were just going to go under, but we're not seeing that. I mean, I was even looking at property rentals for Big Bear for myself to go in February, and so many things are already sold out. There's a booming business for that. People are wanting to get out of their condos and apartments and homes and go somewhere, do something different. There's a lot less opportunity for them to travel right now. Some people aren't willing to fly. They're just willing to drive places. And these vacation rental homes, whether they're using it for them to escape to or using it as a business, are staying very popular. So even when we look at that, like Arrowhead, we're seeing a similar trend where prices are up. sales are up. It's just a very hot market for those types of properties and in those locations. Lake Tahoe, same thing. Okay, so the high end. This is something now that's different. So for example, Newport Beach, or you could even say certain neighborhoods of Los Angeles, you know, some of the areas in the Hollywood Hills, Hancock Park. Some of these areas are going to be similar. When you're looking at properties in the high end, the median prices have not necessarily gone up like they have on average everywhere else. Median price for Newport Beach is 2.8 million. To me, really anything over 2.5 million, we have not seen a substantial increase in price. They're either flat or have been coming down. They've been coming down over the last couple of years. So that upper end is really different. And that's something, you know, to be aware of. So we talk a lot about averages, but you really need to know your particular neighborhood. Carmel, similar thing. Okay. 2020 Annual Housing Market Survey. Let's get into this next section now. So this is a really important slide that I have shared every year with my agents. It's the percentage of first-time homebuyers in the market. We are seeing more first-time homebuyers in the market than we have in 10 years. We're above the long-running average, and we expect this number to go up. A lot of it's because interest rates have come down quite a bit. And rent prices were up at such a high point, so we got a lot of first-time home buyers because they're just sick and tired of building their landlord's wealth. They need to build their own. So this is something I would encourage you to think about, how you can incorporate first-time home buyers into your business plan moving forward for 2021, because that number I anticipate is going to go up. It's a wonderful opportunity for us to reach out to first-time home buyers and help them build wealth, help people who are renting get out of wealth. I mean, if you're a realtor and you're renting, this is a great time for you as well to kind of think about what is it going to take for you to stop renting and to become a homeowner and build wealth. You know, one stat that I share at homebuyer seminars that I put on are comparing, two individuals who are making the same amount of money. One rents and one is a homeowner. Over 10 years, the wealth accumulated by the renter is about $2,500. The wealth accumulated by a homeowner is $250,000. These are averages and stats from the country. The numbers here in LA are much higher. They're probably double that. So it's our job to help our clients really build wealth, and getting first-time buyers into the market is a great opportunity to do that and help someone build wealth. I mean, I'm super passionate about first-time buyers, and I put on a lot of seminars and really work with my agents to make sure that this is a market that is part of everybody's business plan. So keep that in mind as you're creating yours for next year. Housing affordability. Now, housing affordability improved this year. It's still, definitely an issue, but this chart, and the next chart I'm going to show you, really tells me a lot. So we're comparing people who are moving out of LA County somewhere else and where they're moving and why. So in the last, 3 years, almost half of the people who left LA County, the number one reason why they left is that they left because it was just unaffordable and they wanted to move somewhere more affordable. That was their main reason. This is the first time we've really seen a big drop in that. It's gone down to 37%. So I really wanted to look more into that to find out why. And we'll talk about that in just a second. But, people are moving into other counties, not necessarily because of unaffordability, but there's other reasons. So keep that in mind, and we'll get back to that. Okay, investors, I promise you we talk about this. A lot of us work with investors. At our office, we have a huge investor meetup group that we do, and lots of education. So if any of you guys are out there are working with multifamily buyers, I would encourage you to check out some of our videos on our YouTube page. During COVID, we've been doing it almost every week or every other week, but the multifamily market has been changing dramatically over the last year, and it's almost impossible to stay up to date with that. So we've been putting out education every other week for our multifamily investors and realtors to really stay up to date. So if you just go to The Collective Realty on YouTube, check out those videos and educate yourself on what's happening out there. So we've talked, a lot about tenant in common properties, about ADUs. We had an amazing speaker, attorney, talk about the statewide rent control rule. So hopefully you all are aware and what the last statewide rent control law that was put into place in January, signed by our governor, what that means. We didn't know if that was going to affect how much that would affect, the multifamily market and investors, but this chart really shows that it's been affected pretty greatly. So this is the first year that we see, investors drop in purchasing since 2001. They're at a big time low. And when I talk about investors, a lot of investors are vacation rental people, or they're people flipping, or they're investors that are buying property to rent it out. In all of those levels, they have dropped. They've dropped the most substantial on investment rental property owners. So people who are buying properties to rent them, that has seen the biggest drop. And like I just mentioned, the statewide rent control rule has played a major part in that. There's been a lot of uncertainty on what's happening with landlords' rights in their own rental properties. Prop 15 and Prop 21, we talked about. Luckily, those look like they're both going to be defeated, and that'll be good. Maybe that will bring hope back to some of these investors to get back into the rental market moving forward. But as of right now, we've seen a big decrease. When you look at people who are flipping, more people are flipping in 2022 than in 2019. A 10% increase. That's something to be aware of. When you look at investors who are buying properties to rent, that has been a decrease. And that's definitely something to be aware of and to see, is that going to continue? Another major decrease that we've seen is international home buyers. We've seen this happening for years. I mean, we kind of, when we were really recovering from the last downfall, we hit a peak at 2018 with 8% of our market was international home buyers. Look where we are now, 1.8%. A lot of reasons for this. In LA, especially, a lot of our investors were coming from China, and it became a lot more difficult for Chinese to bring money out of the country, and that market just really went away. So that was a big part of it too. But if international properties or anything is part of your portfolio, or your company is really promoting, international buyers and everything, we're going to be giving you these leads, it's not really happening much anymore. So that's definitely changed, and that part of your business model needs to be addressed too, if that has been part of your market. Okay, going back to quality of life and why people are moving. More people are moving this year than last year because of quality of life rather than housing affordability. This is really eye-opening to me. We've always had housing affordability be the number one reason why people are moving out of the county or out of the state. This year, it's not. The number one reason that people are moving, that our sellers are selling and moving, is to have a different quality of life. Okay, so what does that mean for us? If they're moving because they're trying to have a better quality of life, we need to understand the neighborhoods we're working in. And also it means that some of our buyers and sellers, they may be moving into areas that we haven't worked in before, we're not familiar with, but we need to understand those neighborhoods and what they offer and the quality of life that our buyers will get in those areas, because that's something that's top of mind for people. So when you're listing a property, really selling the neighborhood, the community, the quality of life that they'll get by being there is top of mind. That is really, really important. So make sure, that's part of your listing descriptions. When you're selling properties, your videos, you're also selling the neighborhoods and the community. As far as people who are moving out of California, we're kind of back at the highest level that we've been at. The lowest was 2013, but now 30% of people who are selling are moving out to another state. That's pretty substantial number. Kids kind of see the rest. So migration trends, where are people going? What's going on? I mean, obviously our housing affordability levels are much lower. 33% of people can afford to buy a house in California, as opposed to the national average where 57% of people can afford to buy a house. That just means if you have a database of 300 people, you have about 100 of them in there that can afford to buy something right now, maybe 200 on average that don't. So, take a look at your own databases and see what those numbers are and where you need to get them at, and adjust to make sure that you're maintaining your level of income that you're comfortable with. Housing affordability by county, the state average is 33%. California, or Los Angeles, is just right here. It's around 30%, so it's a little bit, less affordable than the state average, but it's not as bad as some of the states, some of the counties. Now, this is really eye-opening as far as affordability. We do not want our affordability levels to be bad. We want it to become more affordable so that we have enough sales happening to keep our industry and our markets moving. Affordability is really important, so don't overlook that. It's one of the more maybe boring stats that we hear, that we're staying at 32% affordability, 32%. It's not as exciting as the median price, the amount of properties, but it's hurting us as far as the amount of properties that are selling. Now, this is kind of like a 30-year comparison of several different factors, and a point I just really wanted to drive in, and so I really wanted to make sure I included this slide. California population over the last 30 years has increased substantially. We can see that here, right? The amount of realtors who have joined the business has doubled. We have twice as many realtors as we did. Well, by the way, the amount of homes that sell hasn't really moved. We're still selling the same amount of homes, even though we have the double amount of realtors. So if there's 200,000 realtors and 400,000 homes being sold, that's about 2 homes per realtor on average that we have available for us. Not great margins, but we know that if you're at the top of your game, you can do amazing in this business. If you get in this business just to kind of run by luck, it's going to be very difficult to get anything, because there's a lot of competition, especially here in LA, and there's just not enough transactions to go around for everyone to actually maintain a great business. So that's that. Now, the only thing that's gone down is permits. So building, how many places are being built? I mean, when you look at this first one, the blue one, of population's increasing tremendously, and the amount of homes that are being built is being decreased. This is not a good sign. This is the main reason why our housing affordability is at the level that it is. We don't want this. Our job as realtors is really to make sure that we're able to build wealth for our clients and for ourselves. And if housing affordability stays as low as it is, it's going to be harder and harder for us to maintain a business. Okay, I just really want to drill that in. As affordability stays as low as it is, our business is just going to become harder and harder. So that means, whether you like construction and new development or not, if you want to be in this business, you can't have both. You have to pick. And if you want to be in this business and you want to keep it going, we all need to be behind new development. We need much, much more housing being built. ADUs could be a great solution for the city, but a lot of our clients don't understand it yet. It's much easier to build an ADU now than it has been in the years past, and it's much cheaper, and it's becoming more. On our YouTube channel, again, we have an amazing architect and financing people that are talking about ADUs and how you can help your clients build wealth through building ADUs and everything you need to know about that. So check that out, because the more ADUs we can get built in the city, the better off we're all going to be in this business. So anything we can do to encourage, development is going to be, I think, just part of our job. This one is, it's kind of sad. It's a majority. It's showing you that 46 of the 143 cities in our state are already majority renters. Now, why do we care about this? Why does this matter? Obviously, if there's more renters, then it's harder, less deals for us to do, but it's much more beyond that, right? For example, in West Hollywood, where I am, it's like 80% renters, 20% homeowners. What we all know is that real estate is still the #1 way for us to build wealth in this country. And if we have 80% of our our residents in our cities not being able to build wealth, and only 20% are, that is going to extremely affect the quality of life and the income that cities have in the future moving forward. We have to be able to maintain our own lives and support ourselves, in the future. And home ownership is one of the best ways to do that. Like I said before, these are, renter cities that these people, a lot of the renters in these cities, the amount of wealth that they accumulate is very small compared to homeowners. And again, it's not because homeowners can afford to buy houses. The stats I'm giving you, we're comparing people at the same income level. So we're at a point now where rents are so high and interest rates are low, where it's becoming more affordable for people to be able to purchase a home. It's our job that maybe they're not going to be able to purchase a condo as large as the apartment they're living in or in the area, but we need to educate them on how to build wealth and how to build that stable future for them, so that when pandemics and when any disasters happen in the future, that we are all protected because we're homeowners. So this is not something we want to see as majority renter cities. We definitely need to increase home ownership, and again, that is going to happen through building more homes. So, one thing you can do as realtors is get involved in your city council meetings. And when there's new developments being pitched, and support them. When there's laws that are trying to be changed to inhibit that, speak. It's really exciting and kind of fun to be able to go to a city council meeting and to speak on an issue. And all you have to do is speak for 30 seconds and say, as a realtor, I see that it's extremely important for development to happen in this city to help our own residents be able to build wealth, and this project will help them to do that. I support this bill, and then be quiet and sit down. You don't have to say a lot, but get involved, do something different this year to help us to increase home ownership levels and to increase development. We need it desperately. I want us to keep our industry going. Okay, so where are people moving? In Los Angeles, the #1 place where people are moving to is the Inland Empire. So when someone sells in LA, a majority of people are moving to the Inland Empire. #2 is Orange County. After that, we have a few states, Texas, Nevada, Arizona. Those would be great states to develop relationships with for out-of-area realtors, and to make sure you're getting referral fees when you refer someone to Phoenix or to somewhere in Orange County. That would be a really smart thing to do and be part of your business plan for this year. So be aware where people are moving to. Inland Empire, Orange County, Texas, Nevada, Arizona. We also see Kern County, Oregon, Washington, Ventura County, Santa Barbara. Develop those realtor relationships. Okay, so the people who are in Inland Empire, where are they moving? Most of them are moving out of the state. Again, we see Arizona, Texas, Utah, Nevada. Since today's the day after election, Arizona, we might see turning blue. Well, a lot of that reason could be because a lot of people from California are moving there. Texas was not quite as red as it's been in the past. A lot of people have been moving to Texas from California as well. These are just interesting changes and trends that are happening that are important to take a look at. Climate change is also something that's going to be affecting our industry, more so in Northern California than here, but it's something we need to take a look at. We've had unprecedented fires over these last couple of years, and we're really hoping that, this doesn't get worse, but it could be something to pay more attention to there. Again, when it comes down to everything, it's like, hey, a home is our home. What is that going to look like for us this year? It's going to be a little different. You see laptops outside in their backyard where people are working, or hey, is this middle picture somebody's home office? Kids are home going to school. There's a lot of intergenerational families that are happening where, some older people, elderly or seniors are moving back in with their kids. Some kids that were maybe living in apartments are moving back in with their family. There's just a lot of challenges, and it's really going to affect the way that our home buyers are searching for properties and what's important to them. So, we're all aware of that. Keep that in mind. And don't be afraid to expand the areas that you're working in, for your business. So, moving forward, we're just about done. I wanted to go over, what are the predictions really for next year? That's pretty bold to even have to talk about that. But, we're not going to just throw a dart. We're going to really look at some key figures and really understand what is happening in the market right now that could lead us to some, to some outcomes of where we may be next year. So, the election is today, and yeah, that's like we said, it's going to affect our market. But really, 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 coronavirus, this is the #1 thing we need to be aware of and be following very, very closely. This is California new COVID cases. By the way, that was a month ago that this was taken. This 3,100 average is now over 4,000. So we are on a pretty steep increase. So we're around here moving forward. We're not at our highest levels. However, the country is at its highest levels right now. So that is definitely not a good sign. Could the housing market in California be different than the housing market in the rest of the country if we manage to maintain COVID? Yes, absolutely. It definitely could, and we have hope for that. So, let's kind of explore what that could look like. One good thing is that we've seemed to be getting the death rate more under control, but this winter is really going to tell us a lot. And we're just at the beginning of fall where things are starting to change. We don't know what's going to happen, but we're at record numbers for the country. California, we're not quite there yet. But we need to definitely follow this. We still have massive amounts of unemployment here. The peak was 31 million, but we have a long road to go. Now let's look at economic outlook, recovery. Where we kind of see ourselves GDP by the end of 2020. We went over this number. We're about a -5, down 5%. Unemployment about 8%. Next year, we expect unemployment to be a little bit better, not much, a little bit, but the main number to look at too is the GDP. If we do have some growth next year, this is going to be one of the biggest factors of affecting our market. We do want that growth, we need that growth, and most of the economists are forecasting that growth. Another number that stood out to me was here down at the bottom. Over the last several years, it was great, we were in the positive numbers. If you looked before that, we had a lot of negative numbers, where the real disposable income, had gone up. It keeps going up and up and up. That more people are having more and more disposable income. Well, it's going to go down next year, and that just means that more people could start to have debt than they have. But this is something that we don't want to continue. It's not too sharp as we might have thought it would be, but it's something that is definitely a big change. Okay, so foreclosures, right? Again, besides COVID, foreclosures we're thinking about as realtors, how is that going to affect our market? Okay, so I would say don't freak out. We don't think that we're going to be like we were in 2028, where 60% of the homes that were on the market were foreclosures and prices were down 40% on average. I mean, we don't expect to be there. We definitely don't. What we're hopeful for and thinking of is, single-digit decreases in price if something bad was to happen, worse than it is. But let's look at some of these points. So, that there could be 60,000 homes that are in foreclosure this week. This in just the state. There's 600,000 nationwide, but just in the state, 60,000. The moratorium is going to end the end of 2020. Let's see in January how many people are paying their mortgage. That's going to be a big sign. So I would say follow that. Talk to your title reps. We have Zoe with Stewart Title, who is on our office meeting every week, giving us amazing updates on what's happening with notice of defaults, notice of foreclosure sales. We want to follow that moving forward because that's going to be a big effect on what happens in our market, and you want to be on top of it. The sooner you know, the sooner we can adjust and figure out what to do. So let's follow that, especially January, February. What are those numbers going to look like? That's going to be a big telling of how many foreclosures come onto the market. Okay. All right. June, we saw a huge increase in delinquency. It's kind of slowed down since then, but again, let's see how that goes. Definitely we could see some price adjustment because of a large number of foreclosures, but we're not going to see a 40% drop like we did in the Great Depression, 2008. It could be just a single digit decrease in prices. And again, each neighborhood, each city is going to have different numbers. So I would also encourage you to talk to your title reps about what are those numbers look like in the areas that you work in. Because if you're working in the Valley or you're working in Beverly Hills, the numbers are going to be very different. Okay. Reasons to be hopeful. The government's been acting very quickly. They're definitely on board this time. They're giving a lot of 5-year workout programs. We see more home equity in our homes. Oh my gosh, that's huge. We can look more into that. Less people are cashing out of their homes. There's a lot less, arms that people are taking. I know I can say it's regarding equity in our office. I track what down payments are being made. And over the last few years, a majority of down payments are 10 to 20%. Before the Great Recession, they were 5%, 0%, was pretty standard. So people have a lot more equity. Prices have come up and continue to come up in the last few years. That's also brought equity into people's homes. So that also will prevent foreclosures. Interest rates going down, again, will also help to prevent a lot of foreclosures because it's making homes much more affordable than they were at their other payments that they were making with higher interest rates as of last year even. So this graph really proves the point and shows you that the amount of cash outs and second mortgage HELOC consolidations, people taking money out of their homes, 2006, 7, all of a sudden people were just taking money out, spending it, taking money out, spending it. They're not doing that now. There was 3 times as many, as much money being taken out then as there was now. That's huge. Now, also, this doesn't really take into account inflation or anything else. When you look at our 134 number, that number really, like the graph, to me, this number is even weaker than it is here. It should be shown as a little bit lower. So, this is definitely something that's hopeful and shows us how we're in a very different situation as we were before. Okay. You guys are being awesome. There's a lot of slides and data. We're almost done. Not as many fundamental problems in the mortgage market, right? With the ARMs lending, we see that they were so high before and they were 3-year ARMs and they would adjust and then all of a sudden their rate would change and their mortgage payments would double and then they couldn't afford it and they had no equity in their home and they had to short sell their home and it was just a disaster. We don't see that happening as much now, much less. Even with 1995 and 2000, we saw a lot more of that. Now we're really at major lows, of those types of programs, which is really great. Household balance sheets, like we said, the amount of debt that people have, the amount of income that they're taking in is at levels lower than we've seen in decades. Which is really great. As we were building up, look at all these years, 2001, all the way to 2008 when things broke, the household balance sheets were not good. They've really been able to come down. So this is a good sign. And same thing with debt to service ratios. That's also a good sign that those are also down and they're at lower levels than they've been in quite a while. Very, very hopeful. Prices were not as inflated as they were in 2005. So at that peak, when you look at the California median mortgage payments to income ratio, it was 72%. That's not very sustainable. That's not very healthy. Our median, kind of historical average is 43%, and we're pretty much right there at this moment. So you may think that, prices are at the highest, but when you look at payments, when you look at income and everything that's out there, it's at a level that's at a pretty much normal average, and that's definitely a good thing. Another layer of saying, hey, we think we're going to be safer than we were last time. We're hopeful as far as what's going to happen next year for our real estate market. We like that. California housing market outlet, what is the most likely results? This is what most people are hoping for next year. Now, when I look at this, I'm thrilled. If we had a year like this next year, it would be amazing. So it's saying that sales will increase by 3%. Hey, any increase next year would be amazing. This year, unfortunately, we're down a bit. The last couple of years we were down. If we could increase and start bringing sales back, that would definitely be helpful. Median price, yeah, we don't want prices to go up too much, you know. I hate when they go down too much, but to stay flat would be good. So a 1% increase, that would be great. Housing affordability, 31%. We don't like that number, right? We need more built. We need to help, you know, get changing that up. But looking at the forecast for next year to keep rates at 3%, that if that happens, that also will really, really help keep our sales up and prices where they are and keep us moving forward. So this is a likely scenario that a lot of people have agreed on. Now, however, there are some things to consider where this could completely change, right? You know, I think we're aware now that things could change dramatically, quickly, and in ways that we've never seen. So let's look at some of those numbers and things that we need to really pay attention to. So the first one is, we will get those great numbers if in the first half, H1 is the first half of 2021, there's a vaccine that's widely available. I think this will happen. We're on track for that as of right now. Who knows what could happen, but we really need to get that vaccine out, to get the confidence level out, to make sure we don't have another summer surge and another fall surge next year. We need to keep these numbers low because we are going to have huge surges this winter. We can't have that again because it's just going to create too much instability. If the vaccine comes out and it works, and we can get that, you know, leveled out through the first half of the year, that is definitely going to be something that is just really important to watch. So keep your eye on that. We can't have a huge, you know, surge of cases this winter. You know what? I don't know. If we have a modest one, I think maybe in California we'll have a modest rise, but I think in the rest of the country, a lot of areas will have a very large rise where I will not be shocked if some areas close and have shutdowns again. I mean, we're already seeing that happen in many places in Europe. So you know, let's pay very close attention to this. GDP growth rate, we really need to have something moving forward in 2021. I think that'll happen. Interest rates, right? We need to keep these at record lows. We need to keep our rates down in order for all of these great things that we said to happen. We need rates to stay low to make that happen. So watch out for rates. And I think that they're going to stay low. I'm hopeful on that one. And then we also need to have foreclosures not be too crazy. We really want them to stay below 8% if possible, so it doesn't affect prices and confidence levels too much. So if it stays below 8%, which is, you know, higher than it is now, currently we're at 5%. If it goes up a little bit, that's okay. If it goes up too much, then that's going to change things quite a bit. Now, here are some, you know, worst case scenarios if these things happen. So if the vaccine's not available till the second half of 2021, okay, like I said, that's gonna create a lot of instability. A lot of jobs won't be able to come back. We're gonna be in some trouble where numbers are not gonna look good for housing. And we'll take a look at what those numbers look like in a second. But first, I want to explain if these things happen, you know, kind of a worst case scenario thing, what that would be. Flu season resurgence and COVID. This is, yeah, it's gonna happen. We already see that happening. It's not gonna be a good winter. California shut down for 2 months. Now, that's worst case scenario. I'm hopeful that this is not going to happen. You know, like I showed you earlier, our numbers are rising, but they're not at the height at when our shutdown happened was. Some places in the country are at their highest numbers. We're about a third of what our highest numbers were. So we still have a ways to go, but those numbers could increase real quickly. I'm hopeful that with our good weather and people being able to stay outside and people wearing masks, that in California, that we're going to be a little smarter and you know, keep our masks on, avoid, you know, gatherings, and you know, holidays are coming. Hopefully we'll all have smart plans for the holidays to not be around as many people. Or, I mean, my idea for the holiday is, I'm like, my family usually has 30 people over. I said, hey, this year, why don't we meet with, people on different days and do different things. So why don't we go for a walk to see holiday lights with 8 people one day, and another day let's go have a dinner outside with another group of family, and on another day let's do something else that's safe, and really just try to break it up that way rather than getting together as bigger groups in one day, because we know that those are the times that COVID can spread the easiest, especially being inside for a long time. So anything we can do to avoid that for the holidays coming up, please try to think out of the box and help to make that happen. We could still have a great holiday season without risking our health. Okay, if we have zero growth in 2021, that would definitely affect our market. Hopefully that's not going to happen. I don't think so. So things are looking good, especially with the spending levels being at the highs and holidays coming. I think that we're going to go into 2021 being hopeful. So let's see. If there's no new federal stimulus deal, this also is kind of contingent on having our, where's our good plan? Let me scroll back to that for a quick second. These good numbers, we want these good numbers. This would be an amazing year for us, and it's totally possible. But again, it's all hinging on, on COVID, on all of these things. And the stimulus deal is part of getting these numbers that we want. So if there's no new stimulus deal, that could definitely hurt. Once the elections are over, I think people will seek, become a little bit more realistic and compromising and get something done, hopefully, to get some type of stimulus package out there, because we still do need a lot of help. The airlines need a lot of help, hotel industries need a lot of help. There's a lot of people that we need to reach out to get our economy, moving in a positive way quickly. We want it to happen as quick as possible. Interest rates, again, we want to keep them around 3%. If they go up, that's going to affect everything. If there's a massive increase in inventory, 20 to 25%, that will change things. That would come from foreclosures, or mostly from foreclosures. If that happens, that's going to affect us. We need to pay attention to that. So far, it doesn't look like that's going to happen in California. But like I said, January, February, those are the months you want to pay attention to. January, February, see what's going on then. That will give us a clue for next year. We're not quite there yet. We don't know what's going to happen. But as it looks right now, we look like we're pretty safe from it, but we just still don't know. So this forecast this year is very difficult to predict. That's why we're doing best case and worst case scenario forecast rather than giving you what we think could possibly happen. So again, foreclosures are also going to become a big part of that. And those are some more numbers to look at. Okay, worst case scenarios, what does that look like for us? Worst case scenarios, this would be, if by the end of the year our sales continue to decrease, which, by a substantial amount, if something happens in December where there's shutdowns, that could cause our numbers to go down from 4% to down to almost 8%. We could definitely see that. If that happens, that's going to lead us into decreases for next year, and that could lead us to 10% down in the amount of sales. We don't want that to happen. This one is a pretty big deal, right? Prices. So right now, 2022 prediction is, if prices were up 4% by the end of the year, so far we're looking at 8. But if it cuts it in half to 4, it'll lead us into next year going into possible price decrease overall for the country of 16%. So we're not looking at 40% like the Great Depression, but 16% could happen if our worst case scenario happens. It doesn't seem likely that our worst case scenario will happen. Maybe a couple of the things will happen. So instead of having, a price increase of 1% in our best case scenario, maybe we'll have a price decrease in the 1 digits of like 5 or 6%. To me, that seems very likely. That, if things don't work out perfectly, we're going to have a decrease. If things work out well the way they're going right now, we'll have a slight increase in prices. Okay, does that make sense? So to me, I'm thinking, we might end up somewhere of a slight decrease. So I would be like, hey, buyers, if you're looking to wait till the prices drop incredibly, if the worst case scenario happens, you might get a 16% drop in your prices. We don't think that will happen. If some bad things happen, we might get a 5% decrease. if we keep going the way we're going, we're actually going to have an increase. So, waiting to purchase a home might not be worth it for you. We know that the rates are at a good rate right now, so you may want to take that into consideration and purchase now rather than waiting. If you're selling, hey, there's a chance that prices may go up 1%, but we don't expect things to go up very much. So if now's a good time to sell, you should sell. If if a few bad things happen, then prices are going to go down a little bit. They could even go down, 16%. So these are things that we need to educate our buyers and sellers on, so that we're able to help them protect their wealth or build wealth. That's our job. Helping our buyers and sellers really help protect them, build their wealth or sell their wealth. We need to know these numbers and these stats to be able to do that. So, thank you for being part of this call to understand what this is. Housing affordability, we don't want that. Housing affordability to go up to 41%. That would be the only good thing that comes out of this, right? It's a little bit more affordable for some people to buy. Okay, potential REO scenarios, again, having a 40% decrease in price is the worst case scenario. 30% REO share of the market. Still, it's not like we were at the Great Recession or Great Depression. We had 60% drop in both. Best case scenario is we would only have 5%. And, I think we might be a little higher than that. We might go up to about kind of where our baseline is, maybe to 5 to 10%, which would be just fine. It would kind of keep our market flat, not too much change, which I think would be healthy. And I would be definitely excited about. The good news is, hey, we're in California, right? So we're still very positive about everything that California has to offer. So we're looking at some of these national numbers, but when we look at California, we have a great economy. We're the 5th largest economy. We have a lot of international people coming in all of the time. We have amazing universities attracting talent, putting talent back here in California when they're out. We have tons of imports, 175 billion. These are just great things that are also protecting us here locally as a state. There's definitely challenges ahead that we face. There's a lot of opportunity, right? I think I've given you guys a lot of points and a lot of opportunity on how to make this market really, really work for you. It's definitely not something to be fearful of. We've made it through the worst of it. And if you're smart and understand what's happening in the market, you're going to do just fine. It's extremely important as of right now to stay educated on everything real estate related, on COVID, on interest rates. You really need to be on top of these stats. Hopefully you have an office meeting that provides you all of these stats. I do it every week at my office, and I make sure everyone knows the most important data that's out there so that they can protect their own business and they can protect their buyers and sellers' wealth. I'm hopeful about moving forward. Like we mentioned, the buyers and sellers' confidence levels are high right now. They're higher than they've been in the last several years. So it's a great opportunity to reach out to our buyers, our sellers. First-time home buyers is increasing. What is your strategy going to be for that? The pool of buyers that have been affected by COVID are not the ones that are buying to some extent. So that's also a super exciting thing as well. Again, stay hopeful, and I definitely am, and I'm excited about all of this. So I would say, thank you guys again so much for joining. Please, subscribe to our channel. We have so much education that we're giving out all the time. Like this video so you can help it. Feel free to share it. Check out some of the other videos we have. Again, my name is Anthony Volin, and I'm looking forward to serving you as the Greater LA Association of Realtors President for 2021. You all are welcome to attend any of my classes anytime. Reach out to me. I'm always looking for talented agents to bring on to the collective. And again, my main mission is really helping you realtors build wealth. So I hope I see you guys again soon. Thank you so much for joining, and we'll see you next time. Have a great week, and good luck on the election.